Hi, I'm James Robinson, and this is my stock pick of the week. My goal when I created this blog is to create a community of people who are interested in value investing, a place where we can openly trade ideas and give each other advice. I don't claim to have all the answers, though I feel like I've done my share of homework. So if you like the blog or find it interesting, please drop me a note in comments. Of course, subscribing and liking are also great as they help me get exposure and build a community. Thank you for watching. My pick of the week is simply a stock that I think represents a great buy that week. My criteria for what makes a great stock is very simple. I look for great companies with a durable competitive advantage and/or extremely good returns on invested capital. Only after I find companies that qualify under that criteria do I look at the stock price to see if they're fairly priced. My definition of a great company and a durable competitive advantage come directly from my study of Warren Buffett and the various investors in his orbit, people he would call the super investors of Graham and Doddville. It starts with the book Security Analysis written by Ben Graham and David Dodd. What I do not do is look for the next great thing. I love Tesla, but not its stock. I'm sure there's a solar company or self-driving car company or super duper gadget company where a $10,000 investment today could make me a billionaire in 6 months. But I don't know how to find those, so I don't look. I simply look over and over again at company after company, looking for companies that are great. Then I watch those companies for when the stock prices become attractive. That's all I do. Thank you for watching. Today's pick is Snap-on Tools, symbol SNA. Snap-on's a pretty diverse company, but effectively they provide tools, equipment, and software to mechanics, to people who fix things. They sell their products worldwide. They have a commercial group, an industrial group, a tools group, and a repair systems and information group. The company offers a wide variety of hand tools. They have wrenches, sockets, ratchet wrenches, pliers, screwdrivers, punches, chisels, saws, cutting tools, pruning tools. I could go on and on and on, but you get it. Effectively, if you fix something or you need a piece of equipment that fixes something, probably Snap-on has your gear. They also make products other than tools which are used in the repairing and fixing of broken things. So they have handheld and PC-based diagnostic products, service and repair information products, diagnostic software solutions, electronic parts catalogs, business management systems and services, point-of-sale systems, integrated systems for vehicle service shops, original equipment manufacturers, purchasing facilitation services, and warranty management services and analytics. So effectively, if you run a shop that fixes stuff, they've got the technology as well as the tools to help you run your shop. Broadly speaking, the company serves the following industries: aviation and aerospace, agriculture, construction, government and military, mining, natural resources, power generation, and technical education industries, as well as vehicle dealerships and repair centers. So they've got a pretty narrow focus in terms of who they service, but when you think about it, that's really a huge part of the economy that they service. The company is based in Kenosha, Wisconsin. It was founded in 1920 and has about 12,600 employees. The company's market cap is $8.49 billion. This is as of July 29th, 2019. Revenues of $4.06 billion. Profits of $696 million. Its PE ratio currently is 12.55. It has a dividend yield of 2.48, and the company has current debt of $946 million. In terms of its grades, the company is extremely well run. It only has one area that's negative, that's in inventory, and you can imagine with the kind of business they're in and the amount of products they sell, that they would need to have a lot of inventories, and they do. That's their one downside. Overall, the company's GPA is 3.4. That puts it easily in the top 10%. In fact, it puts it in the top 5% of my companies that I've looked at. So, in general, this is a very solid company. Again, to reiterate, I say this every week, I rate great companies on a scale of 1 to 4, 4 being the best. I look at 29 different categories, about 9 of which are operating, 10 are financial, and 10 are management. Management is how well the company returns money to us, the shareholders. Financial is what the company does in terms of risk and debt. And operating is how well they deliver goods and services to their customers. So for gross margins, this company's gross margins are strong and getting better. Again, anything over 40% is a gross margin that I'm interested in, and this company's are north of 50%. So they do a great job in gross margins. And again, we look at gross margins for a number of reasons. It's the number one thing we talk about for a number of reasons. It allows us to make mistakes. It demonstrates that we have pricing power. it means we're more and more likely to be a consumer monopoly versus a commodity business, the higher our gross margins are. So here you can see earnings and earnings per share. Obviously, the company's gone straight up since 2009. Only had one bad year during the recession, and that's one of the reasons I like this company, because it's relatively recession-proof. The argument here is if the economy's going really, really good, people are going to buy new stuff. If the economy starts to do badly, they're not going to buy new stuff. They're going to spend more money repairing the old stuff. So the company really is recession-proof. Basically, since 2006, the company's earnings have gone straight up. And the earnings per share have gone up marginally better, but really the company hasn't done a great job of buying back shares. So these two charts are virtually the same. Net earnings as a percentage of revenue. Again, here you can see that the company's done better every year since 2009. They're still not in the top, they're in the top 25%. They're not in the top 10%. But this is an industrial company selling industrial products. So I guess I didn't really expect they would be, in the same arena in terms of, say, a software company. But they do a great job, and they're doing a better job year in and year out. And so the net earnings as a percentage of revenue is really, really solid for this company. I'm not sure what's happening here with selling and general administrative. It shouldn't have dropped to zero, and I'm not sure why it did. I've checked the math a couple of times. Obviously, they're doing something with their accounting where they're putting those costs into some other category. And they were exceptionally high, and now they're exceptionally low. So I've looked at other things. I don't really understand what's happened here. But the rest of the numbers look solid enough that I think what's happened is they just pushed those costs into the categories. Plants and equipment, you'll see that they are a little bit higher than we'd like in terms of plants and equipment, but not dramatically so. And again, this company manufactures a lot of things. They have a lot of warehouse space, and so they're going to have a lot of real estate. So I'm not really that bothered because I understand what's going on with this business. So there's no question about it. The inventories are too high for this company. Inventory as a percentage of revenues is, over 10% and closing in on 20%, and it's not going down. This is a cause for concern. It's kind of in one of those areas where if it had to be bad, this is the right way to have it bad, because at the end of the day, inventories at least are assets. And while some forms of inventory become obsolete, fashion, for example, the inventory in the tool business probably doesn't become obsolete, right? A wrench is a wrench is a wrench. And if this number gets to be too high, they can simply allow it to be, they simply stop buying new ones or producing new ones and allow them to sell. The other thing is the inventory never gets stale, right? If you're selling bread or milk, you got to get rid of that inventory. With wrenches, it's not the end of the world if you keep too much. So it's less of a concern here than it would be with other companies, but it's not without a concern. R&D, the company spends next to nothing on R&D, which is great. That makes up for some of the evils that this company has under inventory and revenues and plants and equipment. So the good news about interest expense is that the interest expense has, as a percentage of revenue, as a percentage of operating income, has gone down every year since 2009. It's very, very safe. It's, I like to see that number at below 15%, and they're below 8%, so they're kind of half of the area where it's a margin of concern, area of concern. Interest expense in terms of total dollars has gone down since 2011, from just over 60 million to just under 50 million. The company's debt's pretty static, and I'd like to see them pay down debt, do a better job of doing that. But they have about 18 months worth of income in debt, so it's not a big deal. And as you're going to see later, the other ratios related to debt are all pretty much very much in the safe zone. Debt analysis. You can see the total long-term debt. It looked like it was coming down since 2012, but in the last 2 years it's gone back up. I happen to know this company's done about $200 million worth of acquisitions in the last year or two. I'm assuming that that's what this debt has gone to. The company does a great job of returning profits based on retained earnings. So while I don't like to see this, and I'd like to see the debt going the other way, the debt as a percentage of revenue and the percentage of profits actually has gone down over the last 10 years, and I just sort of am willing to take this level of risk. The reason I'm willing to overlook the debt is because if you look at years income to pay off long-term debt, I like to have that at about 4 years, and they're at about 18 months, and that number has gone down again every year since 2009. So what this really means is the company's debt, has gone up a little bit or has remained constant, but the company's ability to pay off the debt is, due to its rising income. Income is outproducing the amount of income that they're making is outproducing the amount of new money they're borrowing. And so then borrowing isn't really a significant issue to us at this time. Another way of looking at this problem is interest coverage ratio. What is the ratio of earnings to the amount of interest they have to pay every year? You can see the company's never really had a problem. I like to see that number at 1.5 or 2 times is a very minimum. And these guys are 20 times that, 10 times that, 15 times that number. So the interest for this company really isn't significant. The debt for this company really isn't significant. I would like to see no debt. I always like to see no debt, but in this case, it's really not that big an issue. Cash and marketable securities, you can see here that this number has been pretty constant. It's always been, really between 150 and $175 million for the last, 10 or 12 years. I like this because I don't think the company's keeping too much cash on hand. They're getting money back out to us, the shareholders, or oftentimes they're reinvesting it back in the business through retained earnings. But I get nervous when a company's got way too much money in cash, just like I get nervous when it has too little. I think these guys are sort of right in the sweet spot. Current assets to current liabilities. Again, just to reiterate, current liabilities are debt obligations or cash obligations the company has to pay in the next 12 months. Current assets is cash and marketable securities or receivables that are due in the next 12 months. And you like to see the current assets outstrip the current liabilities with some margin of safety. This company is clearly within that range, and therefore we have no concerns about current assets and current liabilities. So there are 4 things a company can do with their earnings. We've seen the earnings going up dramatically. There are 4 things a company can do with those earnings. They can pay down debt, which they're not doing very much of. In fact, they're borrowing net new money. They can pay dividends, and the company does pay a 2.5% yield in terms of dividends. I'd like to see them pay more, but the dividends, as we'll talk about later, have been increasing. They can buy back shares. The company's done a little bit of that, but not very much. And the 4th thing the company can do is retain those earnings and reinvest them in operations. Now, if a company's going to do that, we like to see that we're getting a good return on our investment. And we can see here that for every dollar that the company's return on investment, we're getting a really good return. This company's very efficient at the money that they're keeping. So we aren't really that concerned that the company's not paying us big dividends or paying us buying back shares, because they found a better way to use that money in a way which is enriching us, the shareholders, even more. So shares outstanding, they've gone from about, in 1999, they've gone from about 58.5 million shares today down to about 56.5 million shares. So they've gotten rid of about 5% of the company, bought back about 5% of the shares since 1999. That's really 20 years. Not very significant. The good news is in the last 2 years, they bought back almost all of those shares. And so if the last 2-year trend were to continue, it would start to add up in a real hurry. We'll see if that continues. But for now, we're really interested in this company because of its ability to invest in retained earnings and get good rates of return on that. We're not so excited about the share repurchase program. So in terms of looking at the share repurchase program in a different light, if you'd owned 10% of Snap-on stock at the end of 2008, you would have owned 5.7 million shares. Today, through stock repurchases, your 5.7 million shares would mean that your ownership in the company went from 10% to 10.2%, so not a very significant amount. However, your share of the company earnings would have gone from about $14 million to about $71 million over those 10 years. So while we haven't bought back a lot of shares, if you'd held the stock for 10 years, you'd be doing much, much better in terms of the profits your company's generating. So dividends, this company's done a great job with dividends, especially since 2011, almost doubling, in fact, more than doubling, almost tripling the amount of money they're paying back to the shareholders and through dividends. In 2005, they were paying $1 in dividends, and today they're paying $3.50. So again, more than a tripling of the dividends per share. We really, really like that. Just on the face of it, this number looks very, very strong. But just looking at the dividend number, the amount paid off doesn't really tell you everything you want to know. So when we're looking at dividends, we look at 4 factors. What is the yield and the growth of that yield? How safe is the dividend in the context of earnings? How safe is it in the context of cash flow? And how safe is it in the context of its current debt load? So we'll go through those with 4 quick slides. So first of all, the yield is 2.48%. The S&P 500 average yield is 1.92%. So it's about 20% above the S&P 500. That's great. More importantly, the average dividend growth for this company is 16.5%. So if you're counting on this company's dividend to pay your way through retirement, you'd get a nice raise every year of 16.5%, which means you'd be doing a great job of surpassing inflation. So dividend safety, looking yielding growth is excellent. The next thing we look at is dividend safety in the context of earnings. The current payout ratio is 28.7%. What that means is that of the money that the company earns as profits, they're paying about 28.7% of that as dividends. Average payout for the last 5 years is 28.1%, so they've been in the same range. To put it in perspective, the average payout ratio for the S&P 500 is around 40%. So this company is more conservative than the average company in the S&P 500 in terms of the amount that it pays out relative to earnings. And even though they're more conservative, they're about 20% higher. So this tells you this company is very strong relative to the average company in the S&P 500. So the next thing we like to look at is dividend payout in terms of free cash flow. So in 2018, the cash flow from operating activities was $764 million. They had capital expenditures of $90 million, which is in line with what they've done for the last 5 years. That left free cash flow of $673 million. They pay about $192 million in dividends, which means that the company is paying about 28.5% of its free cash flow in dividends. This number is very sustainable. The average for the last 5 years has been 30.7% in free cash flow. So this company is very, very safe relative to its dividend safety in the context of cash flow. So finally, I like to look at dividend safety in the context of its current debt load. And so what I really want to see here is what would happen to this company's ability to make a dividend payment if its interest obligation for its debt was to increase. The idea is your interest remains the same, the economy gets worse, and interest rates increase, and when they do, how high can they go and you still meet your payments? So just to skip to the very bottom, if your company was all of a sudden having to pay 20% interest, which is historically as high as we can imagine, on its debt load, the company would go from what it currently pays in cash flow, it pay $138 million of additional money in interest above and beyond what it's paying today. The new interest adjusted cash flow would put the company at $534 million. Again, it pays 192% dividends. So free cash flow minus dividends would be $342 million. So that means that the dividend payout of cash flow at this level of debt load with 20% interest would be 35.9%. So again, this puts in context one of the issues that this company has some debt, but it doesn't have too much debt. It has, in fact, so little debt that if interest rates went to 20%, this company would still be above average in terms of the amount of debt that it's using to pay its, the amount of earnings that are left after paying the debt to pay its bills. So it's very, very safe. All investors like charts that go up and to the right. We like them more when they go up and to the right with some significant velocity. This company's debt load in this company's shareholder equity was about $1 billion in 2005. It's about $3 billion today, so it's tripled in 13 years. That's a fantastic return on equity, or that's a fantastic amount of increased equity. One of the things we really look for is companies that are able to earn high returns on assets. We don't like companies that need to hoard a bunch of money and use that money, and then they don't do a very good job of returning profits to us. So this company's return on assets is in the top 10% of any company in the S&P. Any of the 1,000 companies that I've looked at. It's been above 10. It's been in the top 10% for the last 5 years. It's been in the top 25% of all companies since 2010. It's up. It's going up. It is high and getting better every year. So return on assets, again, is one of the things that I really like about a company, and in this company, I like it quite a bit. Return on equity is really the same thing as return on assets. However, the equity number is bumped by the fact that the company will typically have some significant amount of debt, or a company will typically have some significant amount of debt, which allows them to goose the returns because they're getting return on equity, not the returns on assets tied up. So relative to the companies we've looked at, this company has been in the top 25%. It's very hard for companies with little or no debt to do much better than that. So this number is excellent. I have no problem with it at all. The first question I like to ask about a company is, does it have a consumer monopoly? So depending on how you define consumer, I don't think that the average consumer in America is even really aware of Snap-on, and certainly not aware of most of their products. But from the research that I've done, it seems that in the narrow field of the industries they service, this company does have a consumer monopoly. This is one of the go-to companies if you're in the business of repairing stuff. The company has solid financials. It had $946 million of long-term debt, and it represents about 18 months of income. We've talked about the debt relative to all the other ratios, and it's safe. Does the company reward its shareholders? It does, but only marginally. The company pays an above-average dividend of 2.5%. The company has bought back some shares, but frankly not enough to earn the top marks. This company earnings have been rapidly increasing every year since 2001. But what makes the stock particularly compelling is its relatively low retained earnings and its high return on retained earnings, as well as its very high returns on invested capital as measured by return on assets. So would I buy the stock at its current level of 154.59? I would recommend the stock, and we're going to buy it and add it to the portfolio today. Every week, the last slide has always been just a look at what we currently own. The companies that are in the fluorescent green are companies that we've owned and have sold. The companies that are in the more turquoise color are our current portfolio. I could go over this more and more, but frankly, I'm going to do a complete, we've had this channel going for about 6 months, and I'm going to do a long video just on our return on this issue. And so I'm not going to spend much time on this slide today because my next video will really go into depth on how well we've done with our prognostications. Thank you very much for your time. Please remember to subscribe and to like, as well as comment. Thank you.